Hello, 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 everyone. Mike Arnold
Turn me on.
speaking.
Turn me on.
Ho- Hold on. Bob already wanted to be turned on. I didn't even get through the introduction.
Do the introduction.
I'm here. Bob's here. Welcome to Path Trading Partners. Subscribe. There we go.
That's a good introduction.
Wasn't that fancy? I practiced it all morning.
That was really good.
Let me get. All right. Good morning, Davey. Heating economy justifies selling. We'll get to all this. Good morning, Patrick. Options 22. Good morning. Good morning, Anissa. Connor says job growth was from kids getting summer jobs. Big drop in September, in my opinion. Bob will address that too. Coco says last opportunity to buy the dip. There'll be no other dips. We're going to all-time
Wait a
highs.
minute, Coco. Didn't you buy where I sold?
Good
Coco.
morning, Eric. Good morning, Jacob. Rich. Bad news equals good news. Good news equals bad news. Hello. Final trading day at last. Huh.
For the week.
I don't. We're in the upside down. Good morning, Jay. Welcome. Thank you for being here. I see a new member catching the live stream. Aloha from Hawaii. You're up early, Kalani. All right, so let's just get right to it. Non-farm payroll Friday. Bob, take it away.
Coco, I got you long from 41.50. So that's it. We'll see how that trade works out. All right, so non-farm payrolls, 528,000. A couple of key points. Number one, so I see a lot of you saying things like, job growth was from kids getting summer jobs, big drop in September. There could be a big drop in September, Connor. There could also be a revision. There's been a few revisions, although the vast majority of them have been up lately. But when you look at the breakdown of the jobs, when you go behind the numbers, the largest number, leisure and hospitality, 96,000 jobs added. That could certainly be summer kids, without a doubt. But the second largest, not far behind, 89,000 jobs, professional and business services. That's not summer kids. So if you think of leisure and hospitality, let's say half of those were summer kids and they get revised out. Next month, it's only going to be revised down to 480,000, which would be still a huge, huge, huge number. Anyway, from that perspective, this particular number, you also have participation rate falling again. All right, so 62.1 from 62.2. That works out to about 200,000 people who have left the labor force. Now, you could say they're all of a sudden independently wealthy, or you could say that they've given up, which seems weird given the JOLTS jobs number that they would be giving up since there's so many jobs. It could also be a psychological effect from people having gotten checks during the pandemic and they like getting checks and not working. All of a sudden, the universal basic income has gone wildly positive in the polls. And I suspect that that's from the checks and people not working with the checks. Lastly, you look at the wage growth. Okay, so this is the thing I've been worried about. And this is why bad news is good news, or good news is bad news here. Okay. The probability of let me rephrase that. The probability of a 50 basis point rate hike yesterday was about 60 something percent. Mike, if you put that up and you hit compare, you can look at the difference. It had shot up to 63.8% probability of 75 basis point rate hike after this number. Okay, that was right after the number. So when you look at the comparison of the two, that's the cool thing they have on this is at the top you can hit compare, and it compares the last couple of days. Top left. And you see the probability of 50 basis points dropping, probability of 75 basis points spiking. Where's it at now, Mike?
Where's it at right now?
The 75, no, the 75 probability. 67?
Let's see, 67.
All right, so here I have a Bloomberg interview.
That's actually the 50%.
Is it? What's the other one? 25?
This is 25. This is 50.
Okay, so either way, it's gone up, right? The
50's
probability.
gone up. Yesterday it was favoring the 25 was massive. Now it's favoring the 50. They were way
I stand
underpricing. Even
corrected.
the 75 isn't on the radar screen yet.
Okay, I stand corrected. So basically, the probability still has shifted for a more aggressive rate hike, and that's kind of the thing. When I sent my updated notes to Bloomberg, because I've got a Bloomberg interview this morning, the probability jumped from 34% this morning prior to my interview to 63.5 post non-farm, and now it's at 67. So it's already jumping. I suspect if things keep going like this, we'll have a 75 probability up there in the 10, 12, 15%. But I also think my target for the Fed funds rate by the end of the year is 4% after this number, because the Fed does not have to worry, given these kinds of numbers, about one of their two mandates, right? Their two mandates are full employment and price stability, okay? They don't have to worry about price stability. Now, I want to talk about one more thing. And I know I've probably beaten this to death with you guys, but inflation is going to drop. And as Mike put that up yesterday, even if we get 0% month over month through the rest of the year over year inflation on CPI's reading of it only falls to 6.3%. And this is the issue. Wages have to keep rising in order to get us back in line with the prices that will never go back down, like healthcare insurance. I doubt that new autos will drop. They're only getting more and more technologically advanced, so the cost basis of the cars are going up anyway. So there's a lot there in terms of prices. There's a lot of price inflation that probably won't go back down. So wages have to continue to rise. And theoretically, that can eat into profit margins for corporations, which can mean the big earnings revisions lower. We haven't seen them yet, not the big ones. So this is why I don't think the June lows are the lows. So Coco will probably say, well, that's another opportunity to buy a dip. But, and it honestly, long term, it is. Remember, recessions don't cause the stock market to go down. Stock go up in recessions once prices are under control. If prices are out of control and they're rising or they're staying elevated, that's when stocks suffer. So the inflation, the wage input, all of that stuff is what you have to be watching if you're concerned about the direction of the stock market. So that's the last thing that I've really got kind of to talk about with this particular number. This particular number backs up the Fed being aggressive, and it backs up inflation not really moving as much as probably they would hope based on the interest rate increases we've gotten so far.
Well, there we have it. There wasn't much going on with earnings this morning. I mean, the market's only down. Well, the S&P down 107 basis points. The Nasdaq down 149 basis points. Coco says, "I bought your target. I was in the money and my stop loss hit, but this is just an overreaction." Coco, if you're going for all-time highs and you just stopped out of a trade,
Your trade was wrong.
you're a little too tight. Either with your, if you actually believe all-time highs and you're keeping that tight a stop.
A couple of things on this. I really don't believe that Coco bought.
I don't either.
Here's the thing. A target, okay, unlike any other level, a target is somewhere where you want the market to go. As a matter of fact, ideally, your target gets exceeded every time so that you don't hit your target and fall and you're not filled. We've all experienced that. You've all had a sell level up above and you saw that price trade, and when you checked your account, you didn't get the price, right? We've all seen that happen. So a target, if you think about a target like this, you think, where do I think the market will go and go through? Okay. A target is not a place where you think the market will reverse. If you have a place where you think the market will reverse, you want to put your target below that so that you get filled. You want the money. You don't want the position. The only reason we take positions is to get the money. Okay. That's it. The second thing is, so that's the serious point to what Coco said. The less serious point is just an overreaction still makes you lose money. So who the fuck cares if it's just an overreaction? Like the reason you get stopped out doesn't matter. The reason you get to your target doesn't matter. The reason you get in a trade should only be price action. And therefore, the fundamental reason to get into a trade doesn't matter. None of that matters. I'll tell a quick story, then I'll probably take off unless there's questions for me. When I was doing risk management, risk controls at a prop firm in Chicago, big prop firm, I was one of their traders and I also handled risk management. A guy came into the office with me and the other risk manager and said, I'd like my limits upped. We said, why? He said, I think the Fed is going to tighten and I want to go crazy long dollars. And we talked about it. He had pretty good performance. So we're like, okay, we'll up your limits. No problem. We didn't up his limits to crazy levels, but we gave him a little more room. Decision comes out. He is short euro. He's short yen. He's short, this is all in futures. He's short British pound, right? The Fed does not tighten, okay? But the market perceives them to be behind the curve and rallies the hell out of the dollar, right? So when he comes, he's literally peacocking around the trading room about how much money he made and how right he was. So we called him into the office. Mike's heard this story 1,000 times. We called him into the office and we said, hey, Jimmy, you're not getting paid on this trade. He's like, what? I said, well, you were wrong. What do you mean? I made X amount of money. I need my cut. That's what I do for a living. I go, yeah, dude, but you were wrong. You said the Fed was going to tighten and they didn't tighten. And he just sits there quietly. And I'm like, dude, we're paying you, you idiot. Of course we're paying you. But don't act like you know what's going to happen. Just put on the move you think is going to happen and shut the hell up as to why. Because you're likely going to be wrong a lot of the times, even when your trade works out. Okay, because why something moves is the weakest thing. If you ask Mike in the hierarchy of questions for a trader, why is the weakest one? So, Coco, if you really were stopped out and you say it's because of an overreaction, you are doomed to failure as a trader because it really doesn't matter why it happened. In other words, you'll ignore price action signals in the future because you think, well, if it overreacts, I'll get stopped out, but otherwise I'm right. Now, I'm making a serious point. I'm not picking on you. It's a very serious point. And that's why price action matters more than anything. And that's why I don't care if stocks always go up. I don't care if crude oil always goes down. I don't care about any of that. Neither does Mike. We care about the next trade and nothing else. And we care about that we're putting out our trades properly based on the price action. That's it.
Hey, Bob, do you think the CPI will miss next Wednesday?
Well, I don't know what the estimate is. I haven't looked that far, but I think CPI will be lower than it was last month. Yes. No.
Let's just see the CPI. Where is it? Where was my CPI? Did I scroll past it? They have it coming in at 8.9 forecast and core at 6.1.
Yeah, I mean, I could see that. I could see an 8.7. Commodities, crude oil, they've all fallen quite a bit. They've fallen more since this reading because they fell quite a bit in August as well. But they fell quite a bit in July. I can see that missing, sure. I can see it coming in lower. Remember what we talked about. That means if it comes in at 8.5, okay, that means the previous level of the index is now 8.5% higher. Okay, so it's still higher from a really high level. So, anyway.
Andrea says, thank you, awesome advice. I've been at this for 5 years, and that's the best advice I ever hear.
Thanks, Andrea. Make sure you follow us on Twitter as well, because we put out a lot of stuff on there. Well, I do anyway. I'm more active on Twitter than anywhere else, but I tend to retweet a lot of the stuff that Mike does. So,
John, one more question quick from John. How come there's 2 to 3 revisions on GDP? Is that why some people think we're not yet in a recession?
Yeah, revisions happen because new data comes in. So they have a date that they release the data, and that's put out ahead of time. But a lot of the data they collect, not all of it comes in on time. So some of the companies will submit late, some of the industries will submit late, so they revise. But they generally don't revise that much. It's very rare that you see a negative 0.9 go to a positive 1.5. but it could go to positive zero point 0.1 or positive zero point 0.2 over the next two revisions. That certainly could happen.
So, Bob, we hit your technical top. Are we headed back down, and how far?
No, 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 no. I'm not saying that. Remember what I just said about targets. Okay, targets are a place you want the market to blow through so that you can collect your money. Unlike Coco's happy to be stopped out and then buy lower with less money than he had the prior trade. So you want your money to be collected. So a target doesn't mean we're going to reverse, even though that's what happened here. Okay, that's what happened is we reversed, but we may reverse back up and go back up to the highs. Coco could end up being right. Coco could end up being wrong, irrespective of my target. Now, my targets are placed around resistant levels, usually a little bit lower. Okay, but the only thing that we've found in researching clear paths was that the market tends to fill that clear path. There has to be other things in place for the market to reverse at the end of a clear path. So that's why my targets are often at clear paths. Like we're doing it right now, where we were heading towards a clear path. That might be an advanced clear path, but on the ES to the downside, a very small one. If we get down past the close of the second, Mike, it looks like we're going into another clear path down.
Yeah.
But that's not a trade, by the way. I wouldn't trade that. It's against the rotation zone. There has to be other things going on. So,
Quick question, Bob. If we're changing the definition of what a recession is, do we not need to be concerned with inverted yield curves?
okay, so a recession doesn't really mean anything. Okay, a recession is not a predictor of anything that I'm aware of. Okay, and as I mentioned to you already, the stock market tends to go up in a recession. So I said this on multiple interviews, right, the last few days, and I'll probably say it again on Bloomberg at 10 o'clock. This is Bloomberg Canada, by the way. So if any of you are in Canada, I'll be on Bloomberg BNN. I don't care if we're in a recession because it doesn't mean anything to investments. Okay. The only time a recession means something to stocks is when we're in stagflation. So stagnant economic growth, a recession certainly fits that, combined with inflation. That's when the stock market does not perform. Okay. Otherwise, recessions, stock markets tend to rally in recessions. So targets don't. Am I still answering the same question? Targets, or was that have I
No,
moved
you're
into the
asking
second?
recession. And if it
Yeah,
changed,
the
does the
recession
yield
is
curve and the yield curve and
okay. So the yield curve has been right 10 of the last 11 times it inverted in predicting a recession. So does that mean there's always a recession if the yield curve goes inverted? No, we just said 10 of the last 11. But we're now at levels that we were before the 1991 recession and before the tech bubble. That's where the yield curve inversion is. So the depth of the yield curve inversion, I think, means that a recession is very hard to avoid. That's the most I'll be able to say it. But when you're looking at changing the definition of a yield curve inversion, I'd like to see that. I mean, zero is zero, negative below zero is negative. Inversion means the yield between the difference between the two things has gone negative. So that's like changing the definition of 2 plus 2 equals 4. But I guess since we can change the definition of man and woman, I guess we can do anything.
by the way, did you the opening price that I have on here for it was down at 47 and a half.
Wow.
Which is pretty much if you look at the lows from '08.
Yeah.
Uh so the lows from '08, sorry, we're down at like that 48 level.
Hmm.
So we've retagged the lows from oh we no, I'm sorry, the lows from the
The
dot
tech,
the tech
the
bubble
dot-com.
was at minus 48 area. So
And
we've
what about
tagged
the
that.
89? What about the 89 inversion? How low is that? We got lower than there, didn't we?
The 89 inversion on the and this is at the end of day stuff is was the low was 40, they only had 46.9. That can't be right. I'll have to double check that.
Why do you think that might be wrong?
46.9. Yeah, because we haven't. It doesn't print till the end of the day. It might be right, but it's generally got lower intraday because the way this does it with monthly data is it sort of rounds up,
Okay.
but it's in the vicinity.
Yeah.
Now remember also, you start getting major market sell-offs when it starts going the other way.
Yeah.
That's the trigger for and where you want to start watching for a bottom. You technically your sell-offs, the major sell-offs happen when the yield curve gets back above zero and on its way to 2 to 2.5 percent. This is the area once you start watching for the major sell-offs once it gets back above zero and starts running back to the 2.5%. And once it gets to this 2.5%, you generally put in the longer term bottoms.
Oh, see, that's new. That's news to me. I didn't know that. That's
Yes,
cool.
yeah, it's some research you should do.
I
So
think I'll,
yeah, so that's where I'll really start getting interested with some potentially repeated down moves. Once this pops back above zero, and then keep playing it until you get up into this low. Can it reverse slightly lower? Yeah, but I'm not really focused on stuff until it at least pops above 1.5 and a half for a longer term bottom, just based off the yield curve. Now then we could get other signals in there before that, but that's one of the things that I will be uh, watching very closely. So that's is HKD still going? I mean, we're still in. And did you see with the AMC with the apes stuff? Oh my goodness. Huh?
what is that?
That's HKD. That was that. I talked about this the other day. It's just what a joke. This is
It
the
doesn't look
markets
like it's still going. Does he mean still going
we're going
lower?
down now,
Yeah. Yeah.
and this thing's
I
going
thought
back up.
stocks only went up.
They do no. The overall market only goes up.
Ah, gotcha.
So, all right, I think let's wrap this up for now. I got to take a quick look at the market,
Yep.
but
All
other
right,
than
guys.
that,
I'll talk to you next Tuesday. Thanks.
all right, and I'll be recording the Jim Iriel podcast this afternoon, right?
Yep. You're on the podcast.
All right,
All right.
so
I'm leaving. Mike's staying. See you guys.
bye. Hey everyone, my major again. I don't think we're going to get there today, but I need to get into even shorter term bearish mode. Besides this little breakdown play is back below about the 4082 to 4090 area. You have these dual significant levels, and then it would be a play to rotation zone. Again, I'll go over my overall before I can tip super bearish again. You'll hear that from the podcast. If we do get that bounce, what I'm watching for also, if we do get that little bounce in the open, because we could be setting up a head and shoulders play also. So I will be watching for a potential bounce in the open, but we remember there's not much else coming out today. And if from the lows on the open, if we do get a bounce, watch for on a bigger bounce, watch for the return to the 50 to 62 and a half on a mine. And I don't know where the lows are because I don't know if we're going to get one more push lower, but revise these lowers. That's what I'll be watching before another rollover play because that would set up a nice shoulder, and that would just be for another short-term correction. Uh, so that's where we sit. So we're still as I said yesterday, in the go-go gadget mode. Even with this, we're still in go-go gadget markets. By the way, crude looks like it will trigger the weekly double top will trigger. So then it's more aggressive on any rallies. It's more aggressively sell rallies. And next target down there is about 77.50, the next major target. Minor, if this was played to the short side, I'd actually use 83.50 as a stop reduction, though, to eliminate some risk because you still do have substantial geopolitical and upside risk things. But with this, it actually could over the next, and this could take a long time to unfold, but it could actually return to the 200-week moving average longer term, and I'm talking many weeks ahead. With that, You are welcome. Sorry we didn't get to a lot of market analysis. I have to get to the open, but I thought it was helpful sometimes to hear the macro. Enough people here have been longer term uh, uh, subscribers and viewers, so you should know how to do some of the key levels yourself. Yes, and congratulations to Sterling, whose son is getting married. Uh, do the courses on the website go over the patterns, etc., in more detail? I'm gonna, yeah, it takes time. I just keep subscribing for now. I'm still working on revising a bunch of stuff, simplifying a bunch of stuff, and putting some new rules in it. So I would just keep watching the stream for now until I release the next batch of them, the revised batch, Legion. You know, I'd appreciate the sales, but I'd actually tell you to hold off for a bit. Okay? All right, with that, I will talk to everyone later. Have a great day. Bye.